Welcome back. In this video, we're going to be reviewing the assignment for the model that we're going to build up together during this video series. I always like to review an assignment at the beginning of any modeling program because I find that it simulates reality, allows us to think about all the elements that are required to properly build up a company. So we're going to review the details of this company right now. I'm going to go through the assignment with you, and then we'll continue on from there. So I'm going to share my screen and show you the assignment. Now you have this because it's part of the learning materials that you were able to download. So let's take a look at it together, review it, and discuss it. Starts by saying financial modeling assignment, initiating coverage. Well, it says that because we've asked you to pretend to simulate that as the new junior analyst in the equity research department at ABC Bank. So let's pretend you're the junior analyst at ABC Bank. Your boss, the senior analyst, just sent you the following email asking you to build a financial model for a company called Blue Containers. So that's our task. And here's the email. The email was sent by your senior analyst to you, and it says subject, initiating coverage for Blue Containers. Here it is. Let's go through it quickly. It says, good morning. I hope all is well and that you're settling into your new role. I just found out that we need to pick up coverage of a company called Blue Containers. Normally, I would put together the model myself when we initiate coverage, but I will be traveling for the next 2 weeks and meeting with clients, so I'd like you to build the model. So that's great. As a junior analyst, it's always exciting to be given the opportunity to build up a model. And here your boss is asking you to do it because they're traveling and they're on the road, they're busy. So they want you to take the first crack at the model. Great. The email continues. I really want to make sure that it's an excellent model. So I've shared my thoughts below on how you should approach every section, including the various assumptions. We can review the model in 2 weeks once I get back to the office. Good luck. So it's the opportunity you've been waiting for, the opportunity to build up a model of a company that you don't yet cover, and the responsibility has fallen on your shoulders. So let's review the rest of this email and talk about what's happening here with this company. So I already mentioned this is a company called Blue Containers. They happen to be a manufacturer of environmentally friendly water storage tanks made of recycled materials. Okay. And these tanks are used by a wide range of companies all over the world. Now, I have to be honest, this is generic on purpose. This could be any company. The process and the discipline that we're going to go through together during this series is applicable to any business. So first of all, as part of this assignment, I asked you to pretend that you are a junior research analyst, but you could also pretend that you are a credit analyst. You could pretend that you work at the company at Blue Containers. It doesn't matter. You could pretend you're an investment banker, a private equity banker, a venture capital banker. It really makes no difference. But for this exercise, we're going to pretend that we're an equity research analyst and building a model for that purpose. So regardless, this company manufactures water storage tanks made of recycled materials, and they're used all over the world. Now, on this note, this could also be any company. This could be a service business. This could be any manufacturing business. This could be a utility, a resource company, a transportation company, a technology company. It really doesn't matter. The discipline and the approach we're going to go through together is applicable to any business. Let's go on. It says the most recent statements available for Blue are from 2022. So that's where we are today. So we're going to assume that we have the 2022 actuals, and I would therefore like you to build an integrated annual model for the company for the next 5 years, 2023 to 2027. Obviously, as we get further out into the future, we would forecast the next 5 years. That should go without saying. And we will be using the historical data and the following assumptions, and it says assume all figures are in US dollars. So your boss, the senior analyst, has gone on to share with you some information. And it says, in 2022, the net revenue was $594.4 per unit, and that was a gross revenue of $694 less freight and warehousing costs. The freight and warehousing is $100. And I'm highlighting a bunch of these items And what we're doing is we're simulating an experience where you're in a meeting or you're talking to someone and they're downloading a bunch of critical information. So we're taking notes. We're making a bunch of notes. This is really common in any modeling exercise. Okay, so now we understand a little bit about how revenue worked in the prior year. We're told that this is a cyclical industry. That's very important. We're going to talk about that over the coming videos, which means that prices are expected to move around. They're not going to stay stable. Prices, we're told, should average around $800 in 2023 and then $725. And you can see here there's movement going up to $825, down to $800, and then down to $750. That over the next 5 years. Some businesses are cyclical, where the prices move up and down. Some are not. And it's your job, our job collectively as modelers, to understand that, to think about that whenever we model any business. It tells us that freight and warehousing costs are expected to increase every year at inflation. Tells us that Blue has a factory, and their factory has a capacity of 420,000 units per year. That's the most tanks that they can manufacture in any given year. They expect their sales volumes to grow at 5% in 2023 and then 4% every year thereafter. So we're just setting the stage and understanding what the sales should look like, or we think they might look like, over the coming period of time, over the future years. Let's continue on. Your boss has continued by providing you some information on the company's operating costs. And it says a breakdown of the operating costs for 2023. The expected operating costs in 2023 are provided below in this table. We can see here they will have some variable costs, some fixed costs. The variable costs include raw materials, utilities, and the fixed costs include rent and labor and some other. It is extremely important. One of the most important things that we need to know when modeling costs is the distinction between fixed and variable costs and how to model them. They are modeled very, very differently. And when we get into the unit on operating costs, there's a whole bunch of videos on operating costs. We're going to go through this in great detail so that you perfectly understand it. Tells us here operating costs are expected to grow at inflation after the first year. Okay, great. It also tells us that selling, general, and administrative expenses, that's sort of an overhead line item that all companies report, SG&A, is expected to be $3.9 million in 2023 and then growing at inflation thereafter as well. Now we're told some information about the capital expenditures, the CapEx. How much money is the company going to spend on new assets every year, and how will they depreciate those assets? So we're told the company plans to invest $16 million on CapEx in 2023, and then 17.3. You can see these numbers. The capital expenditure is going to ramp up every year for the next 5 years. We're also told the company uses the straight line method of depreciation. We're told that the existing assets have a remaining life of 25 years, while the new assets will be depreciated over 30 years. So this is critical information to know about the company's fixed assets. Your boss has said, based on historical data, please make reasonable assumptions for the working capital days over the next 5 years. So reasonable assumptions for working capital days, what exactly does that mean? Well, we'll talk about that in the working capital videos. There's a whole unit on working capital, and we will be talking about working capital ideas, concepts, how to forecast and model working capital, and how to choose appropriate days. Next, we're told a little bit of information about income tax. It says the company's tax rate is 35%. That could be whatever. Whatever company you're modeling in your life, you need to understand their tax rate. It says, this is an important note, and we'll talk about this a lot during the tax unit, during all the tax videos. It says the aggregate reduction in government pre-tax earnings due to timing differences between the accounting and government rules is expected to be $5 million per year for the next 5 years. Now, that might not make a lot of sense right now, but we'll go through that in great detail in the tax videos. Finally, on this page, it tells us the company has debt. Most companies have debt. And for this company, for Blue has senior secured term debt and a revolver. And they both pay interest at a fixed rate of 6% per year. So we need to know that. But again, remember, there's senior secured term debt and there's a revolver. It also tells us that excess cash, if the company ever has any excess cash in their bank account, this excess cash will earn interest income at a rate of 1% per annum. We're told that the senior debt has to be amortized. So the amortization on the senior secured term debt will be $25 million per year until the debt is repaid. We're also told the company will draw on its revolver if it ever has a cash shortfall. So we're going to talk a lot about debt in the debt videos, in the debt unit, but this is some information right up front. It also tells us that the revolver has a sweep. A sweep means that whenever the revolver is outstanding, if the company has borrowed on its revolver, any excess cash flow after dividends and share repurchases, any excess cash flow will be used to pay off the revolver, to repay it. So we'll talk a lot about revolver structure, revolver discipline, revolver mechanics during the revolver videos when we get to debt. And then last, as we get towards the end here in the equity section, we're told that this company has 14.8 million common shares outstanding, and the stock recently closed at a price of $11.50. That was the price of the stock, was $11.50 per share. We're also told that there's a dividend. The dividend for the common shares is expected to be based on a payout ratio of 20% of net income. We'll talk all about what that means in the equity videos. We'll talk about common dividends. We'll talk about preferred dividends and the distinction between them. That will all be happening later in this program. And then last, your boss, the senior analyst, has said, hopefully you now have everything you need to get started. Feel free to make any other reasonable assumptions that you may need to build the model. I look forward to seeing the model in a couple of weeks. So this is where we're at. You've been asked to build up a financial model for this company, Blue Containers. And I got to tell you, usually when people are given an instruction page, or you're in a meeting and you're verbally given a bunch of information, or you're given a bunch of information on a page like this, usually the most common feeling is that people start to feel overwhelmed. It's normal. We just went through a lot. We talked about tax and debt and equity and working capital and costs and revenue. There's a lot to process, a lot to understand, a lot to remember. Well, for the rest of this video series, we're going to go methodically, step by step so that you understand exactly how to take each piece of information and properly build it up into a model. So let's go through here some instructions based on the email from your senior analyst. Let's review the instructions before we wrap up this email here. So again, this is based on the email. Let's go through what's happening here. And it says, using one of the worksheet files provided. Now remember, I told you in a previous email, I'm just going to highlight this row as well. This is based on the email. It says using one of the worksheet files provided. Now, in a prior video, I told you that there are 3 worksheet files, a beginner, an intermediate, and an advanced. You need to pick one. I'll show them to you in an upcoming video, but use one. Start with one of these worksheet files, and the information in this case, build a financial model that forecasts the company's financial statements annually for the next 5 years. We're going to do an annual model, and we're going to do it for the next 5 years. That's the instruction that we were provided. So we need to create an assumptions page to enter your inputs. Make sure the assumptions page is logical and well organized. We're going to need to build a scenarios section to run 3 different cases. We're going to want to run a base, best, and worst case in this model, and we'll talk about that when we get there. And we're going to build the scenarios on a few of the assumptions that create the most variability on the company's earnings. So we're going to make some reasonable assumptions for the best case and the worst case when we get there. Then it says create schedules for the key items that will appear on the financial statements, summarize the key operating and financial results for each case, and make sure your model is set up nicely so that it's formatted and printable. So I'm going to stop my share now as we wrap up this video. As I talked about earlier, it's so critical to understand what we're getting into. We've now reviewed the case. We understand the company high level. We've talked about the major sections that we're going to need to build. It's overwhelming. It's often overwhelming when you get started. And so as a result, maybe the most important thing you can ever do when you're about to start a new model is to have a plan, to build a plan, to think about a plan, to get organized and to plan everything out properly so that you can get started well. So that's what we're going to do in our next video. In the next video, we're going to get back together and we're going to talk about how we're going to plan all this information so that we can get this model built and organized in a very dynamic, effective way.